we'll move right into the AVID Investors Club market and rental market update. Okay, so the 10-year treasury yield is the baseline for our mortgage rates, and mortgage rates have really been affecting the story of our real estate market, affecting the demand and buyers' buying power significantly. And so right now, the 10-year treasury yield is about as low as it's been since the end of March this year. We've seen the fluctuations in rates affect supply and demand. And so Dave Rusk showed us this. It's usually about 1.72%. The rates are about 1.72% above that 10-year treasury. And so he's hopeful that the treasury yield continues when the market opens tomorrow. And here's an example of what rates are looking like right now. If you're talking owner occupied, you can get under 6.6% if you're going to do a 20-year loan. But I'm not sure how many buyers are going to, want to take on that payment that higher. Otherwise, you're at 6.625%. And if you're a 40% down for an investment property, that makes sense because it takes about 45% down to cash flow on investment properties in this market at these rates. So plan for 40% down, and then you'll get 6.875 on your investment deals. A little more if it's got multiple units, fewer if it's a single family. So these rates have been contributing to the story on our median sales price. And here's a long time frame. It starts way back in, before 2010. So probably around 2008 over here. And our low was back over here, our market low around 2011. And our market high was right here in spring of 2022, specifically in April. So where are we now? Well, you can see there's folks who are selling who, if you have to sell or if you're moving and you bought in April 2022, you might be selling for a little bit less than you paid. We've seen a little bit of that, more so on the buy side, which I appreciate than the sell side. But Bill McBride of Calculated Risk has pointed out that the monthly payments have more than doubled in the past 3 years. And so he doesn't think we'll get back to all the way down to 4% mortgage rates, but home values have continued to climb. So the Boise Regional Realtors is coaching that it's more important than ever to show historical price trends to buyers so they can see where our market sits and what it's doing and make an educated plan for their real estate purchases. So Boise has been really big on appreciation and value increases, and that's kind of and the growth has really kept us afloat. And so far, what we've heard is that Boise will experience ongoing growth, or it's expected in this area. So that props us up. But so we got the price game, and then we've got the inventory game. And so you can see here that our inventory was spiked up right after the highest prices. So it was the lowest right around the time where we had our highest price, and then it spiked up. And so now we seem to have sort of stabilized from some of those more drastic changes. And this is what that stabilization looks like. So our single family home trends in Ada County, we see that the resale, well, the median price of homes is just around $550,000. And its resale is $30,000 greater than it was last May. So it's up from last May, but down a little bit from last month. So that outer arrow is last year and the inner arrow is last month. And so our days on market are up a little bit, especially in new construction. And the number of sales that we've had is up a little bit, with the highest being back in 2022, at which point in that, when all those peak sales hit, the median was 592,000 compared to around 550. And our inventory boosted, but pending contracts took a little nap for existing homes. Now, how's that look for Canyon? Similar, except just different sets of numbers. Their median's only 420,000 roughly. And their market time has been warming up in terms of things have been moving a little bit faster. So their market time is going down from 43 days on market. It's a little bit lower, but resale is only 29. And we haven't seen below 30 days on market in Canyon for quite a while, like 20 some months. So that's kind of speeding up a little bit. And new builds, we have a resale pinch. No, new builds, I don't remember what was that. Let me think here. Oh yeah, new builds are up, but resale homes were pinched a little bit, or down. And 6 months of inventory. And so a balanced market is around 4 to 6 months. So we're still slightly on the seller's side of the market in Canyon County. Okay, duplexes and fourplexes. So multifamily, a lot of us were talking about starting with duplexes. What is that doing right now? Our inventory increased a little bit in duplexes. Our pending deals went down a little bit and sales jumped. Absorption is all over the place. This data is all over the place. We just don't have clear indicators saying this is the trend. For the longest time, everything was going up, and it was just very clear indicators. And if you're hearing a lot of data that's up, down, that's right. It's everywhere. It's everywhere all at once. The largest increase in inventory and the longest absorption is Ada County fourplexes. So all of a sudden, we have almost 8 months of supply of Ada County fourplexes. So that could we had no fourplexes in March, none sold. So this could put some downward pressure on fourplexes. So if you're in the market for a fourplex, you see high days on market. I don't know, maybe we'll find out if people really want to sell.
Pardon, Stacy,
Yeah.
have you seen brand new built things?
Both. Yeah, there's the brand new builds. Some of those are selling, some of those are sitting, some of them are coming on and off market. There's just a lot of jumping around. Yeah. So Drost's ADA data. I don't know why we never called it that before. Fourplexes. What's going on with fourplexes in Ada County? So at the beginning of June, Ada County had 21 fourplexes, 19 active and 2 pending. And the highest number, this was the highest number since June 2019 in terms of inventory. Then, of course, no fourplexes sold in March, as we said. Cap rates increased a little bit. The cap rate trend we expected with this jump in inventory, it might kind of put some downward pressure on cap rates, but we have not seen that in the data yet, although we do expect days on market to rise. The green on this chart shows the active inventory. You can see that that's significantly higher than the blue line, which is the number of solds. So we do have a story of fourplex here building up inventory.
What do you conclude? This is the highest that it's been for so long. What's the impact on the economy or on sales or other economic issues?
Well, both. So interest rates climbing has made it such that you have to put 45% down to break even. Or 40%, 35% to break even, 45% to get some cash flow, something in there. That's a big down payment. It's a lot of money to put down before you start getting anything back cash flow wise. And so your buyers are going to be your 1031 buyers, your cash buyers. Some of your finance buyers are following the push that interest rates are giving them, which is holding on because of that.
I mean, days on market's going to increase.
That's what we think. And we think that cap rates should decrease a little bit, but so far they haven't. I also think sometimes in real estate trends take some time it's a slow moving barge. So sometimes it just takes time for those trends to show face. Here's our days on market graph. You know, we saw in 2023, it went up and it's a little bit lower. And when money was free in 2022, it just really made things fly off the shelf a bit. Look at all these active fourplexes. This is just Ada County. And there's some of these I wouldn't buy. So if you're going to buy one, even if I'm not your agent, you can let me know which ones not to buy. There's a few of those I'd strike off the list. A few of those we don't like. But there's, you know, they're ranging in price. We've now got, looks like we have 2 below us in price, below Priest. And yeah. Here's what's active in Canyon. Canyon's kind of really been pulling ahead in terms of not having such interesting drastic changes in data. So we've got 2 price decreases. Those little red down arrows show price decreases. But Lexi's been overpriced since the start. It had 161 days on market and they were just trying to get too much. Surfers Point is one of those brand new dealios, as you were asking about, Janice, but those have the high HOA fees and the closed management, and it's Fourplex Investment Group. So they are the developer, the builder, the realtor, the property manager, and the HOA property manager, and you don't really have a choice of a lot of that. So some folks don't like that. Even 5+. So we always talk about how there's more fourplexes here in Idaho than other things, but we've had a few, little time for these 5+, larger apartment buildings to hit the market. And the numbers oftentimes follow fourplex trends. That's sort of our cap rate data trend setter. But what's interesting is I was looking at this $6.2 million 24-plex, and the GRM of that was 300. That's a high GRM. The lower, the better for you. And for those of you who aren't always hearing me fling around the terminology, it's the purchase price over the monthly rents. And so, you know, if it was the 1% rule, $100,000 a month rent on a $100,000 property, that would be a 100 GRM. So that made me look at this hamlet. It's not brand new, but it's fully leased. It's 20 units. And it's a full $1 million cheaper, and it's only a couple years old. So I was thinking, and the gross rent multiplier on Hamlet, which had a couple more bathrooms or a couple more bedrooms, was just a titch under what our fourplex average is. What was our fourplex average gross rent multiplier? Oh, where'd that slide go? Shoot, I lost it. Days on market. Huh. Okay, well, gross rent multiplier was around 192. So yeah, that Hamlet was right in there as well, maybe a 190 gross rent multiplier. Sorry to go all crazy on the slides here, but this is what so that Hamlet caught my eye. I haven't run a full pro forma on it, but I like the looks of the units. It's got good freeway access. It's in Caldwell, but Canyon County's really been holding its own on the data. So that one kind of struck my fancy a little bit. I might want to run a whole pro forma. I'm not going to run through this NARPM data because we're about to get our new NARPM data. This was Q1, so we're getting further and further away from Q1. A couple slides. I'm sorry, guys. Don't look if you get. So a couple slides disappeared on this, and I'm not sure where they went. So I will just tell you what they said. How about that? One of them was the first rate property management market update, and one of them was Danielle's update. I wonder, this happened last month. I wonder if our Dropbox is taking time, if it's not like updating quickly and you're not getting the latest and greatest version. We're not getting it when we pull it up here. So I'm going to notice that. So for next time. Okay. First Rate Property Management. Melissa Sharon gave me some great juicy data. She is the president of First Rate. She's also the president of NARPM now. And we're all wondering, because we see all of these new builds coming on and coming on and coming on, has that affected vacancy? They manage 1,100 units. So they've got a good pool to choose from. More of those are multifamily than single family. And they have not seen an increase in their vacancy rate. In fact, their overall vacancy rate was something around 3.3-ish. And this last year at this time, and this year's was around 3.1. So it had actually gone down a little bit, which I found interesting. And they pre-lease a lot of their stuff, which is a great thing to do. And their pre-lease vacancy rate was 1.5-ish. So they have, yes, when they get notice, they rent it before it's even really vacant. They've already got their next tenant lined up. So they had, let's see, what was it? Pre-leasing. Oh, no real rent increases this year. They're not boosting rents. We've seen rents go up and up and up, and they're not really boosting them. They're kind of renewing them at market, and except in cases where the market rents are lower. And I think that's mostly what what they had to say this month. And Danielle, you had some great stuff.
Yeah,
Without a slide, let us know, what are you seeing?
so very similar, but in our vacancies about the same. I did talk to somebody that got a report from apartments.com that vacancy is continuing to rise. However, I personally have noticed it. Sounds like Melissa hasn't noticed it as well. I think it's been a weird month in the sense of last week was extremely busy and this week is extremely slow. So we're still seeing that, but we are in the summer months where things are busier. Yeah, keeping renewals similar or small rent increases is what we're doing as well.
So we really got to focus on keeping those tenants. For a little while there were, tenants banging down your door anytime we had a vacancy. And so now it's get them in the door and try to keep them there. And do the pre-leasing when you can. Does Urban Edge, and Danielle is with Urban Edge Property Management as well as licensed agent with Swope Investment Properties. So she gives us some of that juicy data.
Yeah, we do all of the pre-leasing as well. That is primarily how we get most of our tenants in. And luckily we have great tenants who are willing to do video tours or even show us their home before they do that as well.
Is that how you do your pre-leasing, to further expound upon Jerry's question?
Yes. Yep, I have a home and I'll send you a video tour and come on by next week. So that way I already have applications in, but I'm waiting for them until it gets.
So the tenants will send you they'll do their own video
Yeah.
tour.
We of course look at it beforehand and make sure it's good. But yes, a lot of people are very understanding and happy that they can just get something before.
I always just use my old video tour.
Yeah.
I was like, yeah, the color's a little different, but yeah, that's way better. Having it a little more modern.
Yeah.
And for those of you who DIY manage, are you doing pre-leasing on your stuff as well as soon as you get notice?
Yeah.
Do you do it in a similar way, or what's your tactic?
We do, and we have the old pictures.
Yeah.
Too. So, we're saying in the ads, we say, this is what it looked like before the person moved in and, hopefully. It'll
Yeah.
somewhat similar.
Okay.
But yeah, we've usually got it rented by the time that, it's vacant, and then we take a few days to clean it up or get it ready. So,
Okay, great, thank you.
So Chris, how many people have it staged versus showing it empty when you get with your vet that way?
Well, I know for myself, the only one that I still self-manage, I just have photos of the best tenants' furniture and I keep those. The tenant who lived most staged, I just reuse those photos. Danielle?
Yeah, normally vacant photos were great. The only time where I've seen staged is when virtual staging.
Yeah, we did virtual staging. We actually did some virtual staging on the Wilson Lane fourplex photo because we find that staging does kind of help warm it up a little bit. And so, but I don't really see people bringing staging into their rentals. So I'll try to grab photos and use the old photos. And then for a while there, I thought every tenant had the best setup ever and they just got better and better. And so it's like, oh, sweet, swap out the photos. But that virtual staging is pretty affordable and it looks good. And so if anybody wants a sample of virtual staging, you can look up that Wilson Lane listing or ask me to email it to you. And we only staged a couple of the photos, but it actually turned out pretty good. It was fairly affordable. And they took our vacant photos and just plugged in some decor. And we used Home Enhancement Company for that. And they were a speaker in February-ish here and gave us some great tips. So. Okay. And I think that was pretty much it, except for the Zillow average rental data. So this is the last rental market update slide. And what we found is all the cities that are in blue versus orange, they've been downgraded to a cool market. They were a warm market for a while, but Zillow is calling us cool now. And you can see that there's a few rent decreases year over year that they're showing on their data. Now, they're not showing us what it rented for. They're just showing us what they have, which is what it was advertised on Zillow for. So, but yeah, Boise's average rent is $17.95, down 55. Meridian's is $21.95, and that's down only $5. And then Nampa is up $30, but they're still calling it cool. And Caldwell is up $200 a month. I had to run it twice to make sure it wasn't a typo. And so, yeah, we've got Caldwell and Boise, their average rents, probably because all this new stuff coming online is higher amenity, higher rent stuff. And whereas Boise is just more established, and so you're gonna have some of the older stuff in there as well. So this is a cool trend to check out when you are looking at pricing. If you're checking your property manager's rents or doing your own, the Zillow rental manager, it's not gonna be the end all be all on pricing, but I like, you know, it carries some weight. So a little more so than on home values. So that's our rental market update. Yes, Dave?
I have a couple of questions regarding vacancy rate. And one is there a comparative rate for each of those cities that, gosh, it must be pretty low if Caldwell's up $200. And the other question is, how are all of the plethora of apartment buildings affecting vacancy rates and duplexes, fourplexes, and that sort of thing?
Yeah, and that is the big question. And so that was kind of the bread and butter behind the questions I asked Melissa on their actual vacancy data is how are we seeing any impact of these new builds? That apartment.com article you mentioned, was that relevant for Treasure Valley, you said?
Yes.
And what did that say in roughly speaking?
11% is what we're coming to vacancy wise.
So
And I'll
yeah,
get more information and we can send it out, because I was like, wow, but that came from the director of Grace.
okay. Director of Graystar Property Management shared an apartments.com stat of 11% vacancy, but our local property managers aren't seeing that vacancy yet. And so, and also, does that include new builds where they're leasing a bunch of the
That's
same?
kind of what I'm thinking.
Because certainly those new builds, if you're bringing on 100 units in one building, that is going to affect that microclimate of vacancy right there. And in theory, we're waiting for it to affect all of ours. But so far, First Rate hasn't seen it affect theirs. We've seen a stabilization of rents, but they did go like this every year they were going up and up and up. So a stabilization makes sense to me. But that's that whole slow moving barge theory, maybe because everywhere I look, I still see things building. So those new units coming online are going to use up some tenants. And it also is going to depend on where your units are. If you're by BSU, or hopefully if you're by downtown, there's going to always be various location draws where someone might be willing to take an older unit, even if they can get a fancy newer unit with a swimming pool and a clubhouse a little further west. Yeah, so those new units over by my Wilson Lane listing, that fourplex, those rents they're 2-bedroom, 1 bath, like 900-ish square feet. And the market rent on those is $14.25. And I called because there's some fancy new builds right next to it. The community is called the Enclave. Knew you'd know. And their 2-bedroom, 1 bath units are renting for like $1,800. So that can draw up that Caldwell rent, but also that's just going to be a different, well, do you want 2 bedrooms or, and can you afford $1,800? There's not everyone can.
And I think primarily why Caldwell is so high right now is there are 3 brand new top of the line complexes being built or pre-leasing right now. And that is why we're seeing rent so high.
Great insight. Great input always. Thank you, Danielle.
Of course.